Welcome back, everybody. It's good to have you to another real estate market update for the greater Milwaukee area. This time, July 2025. We are already past the halfway mark for this year. Back from the holidays. I hope you and your family had a great 4th of July week. Maybe you got out of town a little bit or up north. I was able to see my family in Austria. We got some epic hikes in the Alps. It was absolutely amazing. And the real estate market took a break as well. We see this every year. It's kind of a slump for the holidays. The market takes a break as well, but we are back at it. The market is back at it. And data is coming in rapidly. We are seeing US home prices continue dropping across many states, but still not the Midwest and the Northeast. So today I want to take a look at why is this dynamic happening, what's driving this, and because of that, can we anticipate that this may be also coming to Milwaukee, and what does that mean for your home or your strategy here in the Milwaukee area? So, and we'll look at some economic data as well. Before we get there, let's take a quick look at the latest data from the single family market in the Milwaukee area, 4 counties. As always, let's start with the inventory. That's the most important thing, because more inventory means more competition if you are a seller. And obviously, if you're a buyer, more inventory gives you more choices and a little bit more room to negotiate because competition is lower. So inventory is really the most important metric. We're up a little bit, 1,620, but if you look below, before COVID, we had almost 2,900 and then over 6,000 10 years ago. So 6,000 is kind of a normal number for a market of our size. So still extremely low inventory with just 1,600. Even though it's a little bit less, we're happy for it. The market itself is very small. Only 1,350 units have sold, so very few families are moving. If somebody is selling a house, then they usually have a very strong reason to do so. And on the buying side, the same thing. If somebody is buying, they're usually really motivated to do so. So we used to see a lot more volume in a summer month. Currently only 1,350. 5 days on market, so that speaks for a continued very fast velocity. You can see below, it used to take a lot longer to sell a house. It's still very quick, especially for homes that are very, well prepared, well priced, well staged, move-in ready. They typically continue to go within 2 or 3 days and with multiple offers. So, same old, you've heard me say this many times. With that, no surprise here, median sales price at $415, up 7.8% compared to July of last year. So that is a significant increase. We've seen a little bit of a slowdown in May when we had that economic uncertainty, but the market has gained a lot of confidence. Agents have and clients have, I can tell, throughout, and so we are back at the usual pace. And you can see below, basically in the last 10 years, Milwaukee home prices have doubled. And in a second, we'll take a look at the big picture here, because I want you to understand, what does that mean? Where does that put us in context to the rest of the US? What are some of the market trends? Like I said, Milwaukee markets were really rattled in May. We have seen a lack of confidence there. Listing prices were down. Agents got very skittish when there was a lot of news about the US possibly hitting a recession. The tariffs was in the early stages of discussion. So how's that going to work? So that worried a lot of people, and we've seen numbers really dip in May. But I already reported that the June market update that we already saw in the first week of June, that recovering, and that has continued ever since. And you can see it, 415,000 plus 7.8% in median sold home price is a very strong statement. June has been a lot stronger. The year-to-date median sold price is also up 7.4%. So looking at a larger data set than just 1 month. So we're looking at 6 months worth of data now. We're up 7.4%, which is kind of in line with what we've seen over the last years for Milwaukee. The July market has come back strong after the holidays, a pattern that we see every year. And starter homes are now mostly over $300,000. That used to be more in the 250 range. There is now not much anymore that you can get for 250. So that's where we're at. Let's take a look on a big picture here. So here we have the last 12 years in red. You can see the US national average, and in green, that is the Milwaukee metro area. So Milwaukee still remains quite below the national average. But if you would put prices here from the East Coast or from the West Coast on, they wouldn't even fit on the chart because they're so much higher. So Milwaukee remains one of the, price-wise, one of the most attractive markets. So we're even below the average. And Milwaukee, if you travel a little bit, is not a below average city. The one thing that stands out here when you look at the Greenland for Milwaukee, we have a very strong seasonality. So to point out the obvious, if you have a choice when you are moving, then you want to play that along, those natural market trends and not necessarily in a time that is not in your favor. So it always depends on your personal circumstances. Happy to sit down with you and walk you through the logistics, especially if you're buying and selling at the same time. How do you take advantage of knowing about this seasonality and what do you do with this? The other thing that is interesting is when you look here in 2022, you can see that we had quite a gap, price difference between the national prices and the Milwaukee prices. And when I take that same bar and copy it over here, you can see that has been almost cut in half. Just visually, I would say that we're not quite there at half, but the gap has closed significantly. And we are catching up. Milwaukee is catching up to the national average, at least. Still way below. I think it's worth pointing out a lot of people that are moving here from the coasts. We work with a lot of relocation clients, and for them, they can't believe the pricing here. It is still so much different, but we're moving up there. We're getting there. So speaking of which, On Point Realty, my team is celebrating 500 homes sold. You can see here on the map where we are typically active. So we cover the entire metro area. And the reason why I'm pointing this out is not to brag here. The reason why I'm pointing this out, this means 500 transactions closed. That is a lot of experience. That is a lot of offers written. That is a lot of offers received on the listing side. On every deal, we sit down afterwards and we say, what went well? What could we have done better? How did the market play in our strategy? And so you learn a lot from things that you're doing a lot. And so there is a lot of experience that is available to you. And if you want to talk about your personal situation, you can reach out to me. You have my email address here. Most people seem to be most comfortable sending me an email. That's the easiest way to connect, m.auerbach@kw.com. Or if you want to give me a call, my number here is here as well, 262-671-6868. Just don't be surprised if I pick up, because that's actually what I do. And then we can talk about your personal situation and what's the best strategy for you depending on your personal goals. All right, enough of that. Let's take a look at where we are in the market. Look at this chart here. I think this is an excellent visualization of where the market is. So we have a balanced market here in the middle. This would be a buyer's market. We are pretty far away from being in a buyer's market. We are very, very much in a seller's market. So sellers have the advantage. Very low inventory. Buyers have to compete. And how do buyers compete? They write strong offers. They write a lot of offers over list price. And that keeps driving up the list price. That's just how it goes. We're relatively inflexible on the supply side. When you look at the map, the green dots here show all the new construction spec homes that are currently available for sale. Most of them are actually already under contract. They're contingent. So it's in total 203 new construction homes. $670,000 is now the median. I looked it up. It's on Candleberry in Grafton. Carrick is the builder there. So that's smack middle of what a new construction spec home is costing you now, $670,000. A few years ago, that was around $500,000, and it seems like it's moving up about $50,000 every year. And they just can't physically build more homes. We're lacking subdivisions, we're lacking the zoning, and the builders are also lacking skilled labor, especially carpenters. I was just recently with a client on a very similar new construction home, and they were just hanging kitchen cabinets. There were 3 carpenters there, and every single one of them was at least 55, 60 years old. So we don't have young people in the trades that can help building more homes. So even if we tried, it's very difficult to just increase the pace. Most homes being built in Waukesha County. Number 2 is Ozaukee, and then we also see some in Washington County. Milwaukee County, almost nothing, because Milwaukee is fully built out. So there's not much empty land and really not much opportunity for a builder to put in a $670,000 house and sell it profitable. That's why we see the growth in the suburbs, and hopefully we'll get some new zoning law that help accelerating that, because we really need more homes being built, and ideally also on smaller homes, on smaller lots and lower price points, so they are more affordable for a broader segment of the population. All right, speaking of inventory, that remains very tight. You have your two lines. The blue line here is active listings. So we had really a slump here earlier this year. This is total inventory. So you had about 1,200 houses in all of the Milwaukee metro area that you could possibly look at. Frankly, quite a bit of that is junk that is not moving. It's either hopelessly overpriced or just a really bad property. So when you dial it down and you look into a market like, I don't know, Wauwatosa or Shorewood, there's one home or two homes or five homes that are coming up in a specific price segment. So that is the reality of very, very tight inventory. 1,200 sounds like a lot, but if you specifically want to buy something in a certain neighborhood, then you find out that it's actually very difficult it's a single digit number usually. So that has been increasing in May and June, which is typical for that kind of the season. But you also have here the red line, which is new listing supply. So this is how many are coming up. The interesting thing is that both of them are quite in the same range, which is of course happening because all the listings that we're bringing to the market in a given month are basically sold in the next month. This is why these lines are in the same range. If it used to be that we had 6,000 units on inventory and sold 1,500, then you would see these lines way apart. But that's our inventory situation. I expect it to not get better from here. Traditionally, you can see how that shapes up during August and September. We still see a good number of new listings coming in, but then October is probably last month, and then as soon as Thanksgiving and the holiday season starts showing up on the horizon, then it starts dropping down very low, and we're just basically sorting through picked over inventory that's left over from last summer that nobody else wanted. But still a pretty good buying opportunity here in July, August, September, and October. So that is, in my opinion, actually the best time of the year, because the list to sale ratio is coming down. If you're not familiar with this metric, this is basically measuring how much people have paid over or under list price. So we are currently sitting at 102.5%. So on average, people have paid 2.5% over list price. Some people negotiated, of course, but the average is 102.5, which also means that a lot of hot listings still go 3%, 5%, even 10% over list price. I've worked on some deals that sold more than $100,000 over list price. We just had a listing sold here in Mequon that went $86,000 over list price. And that is happening on a regular basis. As soon as we are over 100% here, that means that we're in the competitive area. Historically, we've always been around 95, 96%. So, if you haven't bought or sold a home in the last 10 years, you're probably still remembering that you can negotiate 3 to 5% on a good listing that's selling on the first weekend, and that a lot of people are interested. That is not going to happen. Good news for sellers, but you still have to make sure that you are positioned correctly, because we also see that nice homes that are overpriced. I've seen one actually last night in Mequon, that is just overpriced by $100,000. It's a really nice home, absolutely nothing wrong with it, but they're not even getting an offer because they're just positioned the wrong way. All right, so what's going on with the rest of the country? Why am I saying real estate prices are falling? We have currently 22 of the 50 largest metro areas where prices are in the red. This is comparing May with May from last year. And you can see Milwaukee here is one of the hottest markets in the US. And you can see a pattern. If you look here, these are all Midwest or Northeast markets if you go down the list here. And on the other hand, if you look here, what's happening in on the red side of the list here, we have Austin, we have Tampa, we have Dallas, Phoenix, San Antonio, Orlando, Miami, Jacksonville, Atlanta. So these are all southern markets that were really flying very, very high during the COVID years that are now correcting down. So we are not looking at a 2008 type market crash. We're just looking at markets correcting. The pendulum is swinging back to the other side. And of course, this has to do with supply and demand. I think I put this one in here. So here are the top 10 cities with the highest rates of new home construction in the US. So you may not be surprised when you look down the list. You got Texas, you got Arizona, you got Georgia, we got New York here, but also North Carolina, Florida, Texas, and Florida. So those are the markets that are currently seeing the biggest price declines because they just went absolutely nuts over the last 5 years, cranking out new homes like there's no tomorrow. And now that's coming back and you're seeing the market correcting and prices are softening in those areas. We don't have that level of new construction. We don't have that inventory. We are relatively inflexible on the supply side because the builders are so constrained. And you can see this also here in inventory. This is a 5-year picture between June 2019 and June 2025. So 6 years. And the brown shaded states are the ones where inventory is now lower than it was before COVID. The green shaded ones are where inventory is higher. And that is, of course, driving the price dynamic. And you can see Wisconsin has one of the worst shortages in the country. And that's why we are seeing the price dynamic that we're seeing. What's the home price forecast on a national level? So we still have quite a few positive forecasts here that are seeing real estate prices growing for this year. But generally, I'm following this every month. Most of them have revised their numbers down. So they used to be more optimistic and now they're a little bit less optimistic. And on the far right, you have two very popular ones, Redfin and Zillow. Both of them are in the negative. Interesting is that Zillow moved up actually. They used to be at negative 1.9% and now they're forecasting just negative 1.4%. But that is the national average. So that includes this chart here. It's across all of that. So that's balancing out the markets that are increasing and the markets that are decreasing. All right, let's take a look at some economics. Inflation has picked up. We just got the latest numbers, 2.7%. So yeah, I don't know what, it's not much, but it's going in the wrong way. The Fed would have liked to see inflation go down. Jerome Powell said yesterday that he thinks we do not see the full impact yet from the economic policy, from the tariffs, and he thinks there will be more. Well, I guess we will have to wait and see how that is shaking out. But this continues to happening and the devaluation of the dollar is continuing. I know because I just got back from Europe, and so I'm keenly aware that I used to go over there and take 400 euros from the ATM, and that was pretty much about $400. And now if you go there and you withdraw 400 euros, that will cost you $500. So that makes traveling to Europe more expensive. It also makes buying things from Europe more expensive. So if you're buying a car, for example, that's been made in Germany, the cost of that is in euros. And because of the softening of the US dollar, whether we have euro, that's right here. Since beginning of the year, we are down 11.47%. So you need to bring more dollars now to buy stuff overseas. We also see that with the pesos. We see this a little bit with the Chinese yuan. And we see this with the Canadian dollar. So that is something to keep an eye on, that we're devaluing the US dollar. It helps us a little bit also with our debt. So because if the value of the dollar is going down, measured in GDP, that means it actually helps the government to repay our debt. So that's the good news, but it also makes it more expensive to buy things from overseas. And that gets me to another topic, which is the US Treasury yield curve. That is getting a lot of attention amongst financial nerds. If you're not, I'll make this really easy for you. So that is basically the US selling US treasuries, and you can buy different treasuries. You can buy short term, that's up to 1 year, or you have your 5-year, 10-year, 20-year treasuries. So you're basically borrowing the US your money, and the US is promising to pay that back to you with interest. And these treasury bills, they get auctioned off to typically very large investors. That could be institutional, that could be countries. And the reason why we are paying attention to the 10-year treasury bill is because that is what's driving mortgage rates. So US mortgages have an average lifespan of about 7 years. That's why investors are comparing investing in mortgage-backed securities with 10-year Treasury bills, because they have around the same lifespan. So they're not looking at the 7, not looking at 20. They're looking at the 10-year typically. And you can see from 2019, we have basically moved up to a much higher interest rate environment. So that's raising interest rates for bonds are really the benchmark for the whole market. Everything else is kind of influenced from the bond market, even though most people don't pay attention to that. And you may have heard that the yield curve was inverted. So that's the red line we've seen here in 2024, because short-term debt was more expensive than long-term debt. And that is usually a huge red flag. Fortunately, that has been corrected a little bit in the last year. The blue curve is now moving in the direction where it should be. The long-term debt earns higher yields, so it's going the right way. The problem with that is also the 10-year is up. And that is what's driving the mortgage rates, because you can roughly say the 10-year T-bill plus 2% gives you approximately the current 30-year fixed rate mortgage rate. So if that is going up, that means mortgage rates are also going up. What are the big banks forecasting? They're all thinking here, you have here the different ones, and they're all basically thinking that over the rest of 2025 and going into 26, we are going to stay in the sixes. I don't know what to make of this. So it's notoriously extremely hard to forecast mortgage rates, because they are not set by the Federal Reserve. They are driven by the bond market, which means that really international investors and national investors are driving mortgage rates. And I look at this and I'm thinking, well, you're forecasting flat, which basically means you don't know in which direction it's going. So I would not be totally shocked if we see mortgage rates being 1% or 2% higher by mid-2026. But, I have no clue either. It's just, I guess you have to be prepared for everything. At the moment, we're holding relatively stable around 7%, give or take a little bit, depending on what your credit score is. But most of the clients that I've seen in the last 2 weeks got their pre-approval right around 7.25. If they didn't have, absolutely perfect credit, that's a practical score. All right, what can we expect for the next few weeks in the Milwaukee area? So first of all, we are transitioning out of the spring market into the summer market, which means it's still a very, very busy market, but it's not as frantic and as hectic as the spring market usually is. So there's still a very good supply of new inventory and homes are going reasonably fast, but it is a little bit more relaxed typically than the spring market. So the next 4 months will really be a sweet spot for both buying and selling before we're transitioning out into the fall market. Supply, I think we will see relatively steady. We have already seen maximum supply, which is typically end of May, beginning of June. But July and August are relatively good markets here as well. So there should be some decent choices in the market. Mortgage rates, like I just said, hard to predict. Short term, maybe a little bit higher. Seasonality, best time to buy is still ahead. So if you can plan it, you want to take advantage of the seasonality. This gets a little bit more complex when you're buying and selling. So that's the part where having a conversation and talking about your personal situation, what are the driving factors there, and how can we time it logistically that it really takes the most advantage of the market seasonality. That's a conversation. And selling, I would absolutely target the back to school time because that's when we see a second wave, when people are coming back from up north and from vacations and are getting more into the real estate market. So if you are thinking about buying or selling, let's talk about it. Send me an email, give me a call. We are covering the entire Milwaukee metro area. So if you're thinking about moving here, or if you're thinking about relocating to the Milwaukee area, send me an email, give me a call. You have my information here. And you can also go to my website and book a call right there. You have access to my calendar and you can pick a time and a day that works for you. That's onpointrg.com. And just look for the red button that says book a call with Marcus, and I'll see you there. And that's all I had for you today. Thank you very much for watching, and I'll see you at the next one.